We have the weaponization of the dollar and central banks hoarding gold at record levels. I think that's one reason why gold has held up so well, despite the high interest rates and other usual headwinds for gold. We're going into an environment where there's multiple reasons for gold to go up, not just some when, not just, eventually 10 years from now, it'll be 10,000. No, there are reasons for gold to go up this year. And we're going into that from a $2,000 base. Like the last time we went into a big ramp up in gold, it was 14, 1500. And the time before that, it was, 11, 1200. So these are big moves up, 30, 40, 50% moves up. If we get that kind of breakout starting from 2000, we'll do the math. It's embarrassing to me to even throw the numbers out there because they're so big. This year, I have said that gold is my highest conviction trade for 2024.
Market expert Lobo Tiggre, editor of IndependentSpeculator.com, shares bullish sentiments toward gold, citing various factors that could drive potential price increases, starting from a base of $2,000 and anticipating significant percentage gains. However, recent market movements saw extended losses for the yellow metal as spot prices slipped below the crucial $2,000 ounce support level. Analysts caution of further potential declines following this breach. Tiggre highlights the expectation of rate cuts by the Federal Reserve, historically seen as positive for the gold-dollar exchange ratio. However, Federal Reserve policymakers may need to wait longer before implementing such cuts, as indicated by a recent government report showing that consumer inflation remained elevated last month. Fed Chair Jerome Powell noted progress in addressing inflationary pressures, but suggested that the upcoming March meeting might be too soon for the Fed to ascertain its success in combating inflation. Tiggre delves into the concept of the weaponization of the dollar and the trend of central banks increasingly hoarding gold, proposing that these factors contribute to supporting the price of gold despite facing typical challenges. Several countries, including China, Russia, and Iran, have initiated measures to reduce their reliance on the dollar and have been actively working on creating alternative payment systems. While it's expected for countries with strained relations with the U.S. to pursue such strategies, even traditional U.S. allies have expressed concerns about American economic dominance and have shown interest in diversifying away from the dollar. Join us as we explore the insights shared by Lobo Tiggre. Stay updated by subscribing to our channel and activating notifications. Thank you.
I think undeniable recession. I think it'll be a hard landing, but even if I'm wrong, the mainstream view is still for soft landing, which is not no landing. A soft landing means a mild recession that just doesn't do much harm, but it's still a recession. And historically, any gold bug can tell you that recessions are good for the gold-dollar exchange ratio. We're also looking at the Fed itself telling us that they're going to cut rates this year. Not as much as the markets want, not as soon as the markets want, but they're still saying they're going to cut. Rate cuts are historically good for the gold-dollar exchange ratio. We're also in a world with not one, but two hot wars, either of which could become World War III. One is on Europe's doorstep. The other one is in the Middle East. That's not important to the global economy. There is a significant geopolitical risk factor here that argues for safe haven, regardless of the economy. And then we have, related to that, but a distinctly separate issue, we have the weaponization of the dollar and central banks hoarding gold at record levels. And I think that's one reason why gold has held up so well, despite the high interest rates and other usual headwinds for gold. So we're going into an environment where there's multiple reasons for gold to go up, not just some when, not just, eventually 10 years from now, it'll be 10,000. No, there are reasons for gold to go up this year. And we're going into that from a $2,000 base. Like the last time we went into a big ramp up in gold, it was 14, 1500. And the time before that, it was, 11, 1200. So these are big moves up, 30, 40, 50% moves up. If we get that kind of breakout starting from 2000, we'll do the math. It's embarrassing to me to even throw the numbers out there because they're so big. To connect it to the other question about the stocks. So these are the reasons why I'm bullish on gold. But the gold stocks are so hated. It's not just hate. It's not just sentiment. The market is telling us, the price action is telling us, and I'm sure you've seen this before. The market is telling us that they expect gold to come down. The stocks typically lead. The stocks are lower. The stocks are telling us that gold is actually overpriced right now and it should come down. And I think the reasons for that are recency bias. The two spikes, record spikes that we have following 2008 up to 2011, gold spikes, peters a little bit and then comes down for years. And the only one before that really comparable was 1980, Same thing. The institutions, not you and me, not the gold bug who goes down to his local coin shop to buy another Buffalo or Maple Leaf, right? The institutions, the COMEX traders, the LME types, the guys on Wall Street, their experience with gold is it peaks and it goes back. It's peaked and it hasn't gone back. The stocks are telling you they expect gold to go down. I think they're wrong. I think they'll be shown to be wrong this year. And then when they realize it, it'll be like, oh my gosh, gold's not going down. The stocks are on sale. And I think we'll see the gold stocks catch up. And this is unlike me to make something so close to a prediction, Peter, but I think that happens this year. I think it'll be very good, at least for the quality gold stocks.
Gold continues its sideways consolidation below the psychologically significant $2,000 mark, lingering at a 2-month low as the European session begins on Monday. Despite hitting an all-time high of $2,135 in mid-December of the previous year, expectations for gold in 2024 were optimistic, with many anticipating the precious metal would maintain a position above the crucial $2,100 threshold for an extended period. This optimism was fueled by signals from the Federal Reserve, indicating potential interest rate cuts in the early months of the year. Reflecting on this period, Tiggre highlights the remarkable shift in perception regarding gold prices. Once considered a significant achievement for gold to reach $1,000 per ounce, the current price of over $2,000 elicits complaints from some quarters. Tiggre finds this ironic, considering the historical context of gold prices and the considerable wealth it now represents. Let's get back to the interview.
People are pulling their hair out because gold is doing nothing. Oh, woe is me, $2,000 gold. What a terrible thing. Like, are you kidding me? You know as well as I don't have quite as much silver hair as you do. But I remember when $1,000 gold was like our wet dream of success. We were, wow, we'd be so wealthy if gold would just rise to $1,000. I remember Doug saying that, but I didn't join the merry band of thieves there in the Sherwood Forest until 2004, by which time it had already moved. I remember in the 250 plus range, Doug wrote, if I could reach through and grab you by the lapels and tell you to buy gold, I would. And if I could call your broker for you and tell him to buy these gold stocks, I would, but I can't. So I'm just writing my newsletter and telling you this is a screaming opportunity. Anyway, but so just think about it. We thought $1,000 if gold should ever reach such a high price, or exchange ratio with a dollar, because gold is money, our ship would be coming in. And here we are complaining about gold just trading along at $2,000. We've spent a lot of time on the two yellow metals. And I see what I love about this, particularly for this year. This is, again, not some way, this is like a happening now based on the trends happening now, is that if you bet on uranium and gold this year, the two yellow metals, that portfolio is self-hedging. Like, let's say I'm completely wrong about the recession and safe haven demand for gold, and Powell has somehow miraculously saved everybody, beat inflation with no harm done, and it's happy days going forward. That's going to cause increased demand for energy. The economy booms, right? Uranium will do great in that market. Gold, not so much. But let's say the recession is really bad and there's a big scare and industrial minerals take it on the chin, energy takes it on the chin, and even though it shouldn't affect uranium so much because it's baseload power, it does anyway. Spot goes down, the stocks go down. Well, in that environment, gold takes off. So without getting out of the market, like I don't just have to stand back and say, I don't know what's going to happen. By betting on the two yellow metals, I can bet whichever way it goes. Now, I actually think the most likely course is in between, and I think both will do well this year. But if I'm completely wrong about one or the other, my portfolio is already hedged. So I think that's the parting thought I'd like to leave the audience with. I think, rather than missing the boat, you can hedge within by betting on both yellow metals.
Geopolitical tensions support gold, but the Fed's monetary policy pivot will remain the key price driver in 2024, according to Ewa Manthi, commodities strategist at ING. Ongoing geopolitical risk in Ukraine and the Middle East supports gold. Prices hit an all-time high of $2,077.49 per ounce on the 27th of December 2023, Manthi said. Still, we believe the Federal Reserve's wait-and-see approach will keep the rally in check. She expects an average gold price of $2,025 per ounce over Q1 2024. That's it from us. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.